It looks like the PBOC's hold today is in line with your team over in Barclays, who was just saying that, you know, they're probably penciling in about 3 10 basis point cuts, but not until after the Q3 GDP print, which is going to come in next month, for more evidence of how the economy is holding up. Yeah, and then we could actually see further rate cuts in Q1 and Q2. Talk us through that and how you're sort of assessing the state of the Chinese economy right now off the back of this hold by the PBOC.
So on the PBOC itself, I think you said it, Sam. It's not the cost of capital that is holding back the economy at all. What is holding back the economy is two things. One is that over the last 25, 30 years, there's been this massive transfer of wealth from the Chinese consumer to the Chinese investment, infrastructure, manufacturing sector through the banking system, right? By keeping bank rates artificially low, keeping mortgage rates artificially high, et cetera, et cetera. And the second is you have very large negative wealth effects now. Home prices have been falling for a while. The property sector, upstream and downstream included, is a very important part of the Chinese economy. You know, when you buy an apartment, you buy a flat. When a new suburb is constructed, there is infrastructure spending, electricity grid build-out, sewage, roads and tunnels, et cetera, et cetera. And that has come to a screeching halt with no sign of a bottom. Those are the two things holding things back. And I think the policy prescription is well understood here. You know, virtually every China expert I talk to argues that you need to put 4 to 8 trillion renminbi, you know, it's something that is truly substantial, in the hands of Chinese consumers and trust them to spend a part of it. But that's a big policy shift. And I don't think it's going to happen anytime quick.
8 trillion?
Trillion renminbi, yes. Yeah. About $1 trillion over the course of, I mean, it's a large economy. It's an $18 trillion economy. Yeah.
Yeah, I mean, the folks over at ANZ, I think, are calling for 2. They say 1 trillion is going to be insufficient. And as you say, needs to go into the hands of the Chinese consumers to make themselves feel better about their long-term income expectations. So now that we've had no change to the LPR, I mean, there still seems to be calls out there in the market that I'm seeing for imminent stimulus. I mean, what form do you think that could take, and when do you think that could bring some confidence back to these markets?
Right. So what it should not, the form it should not take is what they have done in the past, right? Which is essentially more pump priming that feeds into more infrastructure investment, more investment in the key industries that they want to own. Because the one thing China has coming out of its ears is excess manufacturing capacity. And it's starting to become a problem, not just for them, but for the rest of the world. Forget the US. You see Europe and Canada starting trade wars with China just because there is so much coming out. Just because you have companies like BYD, right, targeting 50% of their total top line to come from outside China in the next few years. This is the world is not big enough at this point to handle continued exports from the Chinese side. So putting more money there, I think, would be a mistake. I do not think they will make that mistake. However, I also don't think that they will put enough money in the hands of consumers. It just seems to be something that Chinese policymakers have been very hesitant to do. What they have tried in the past, if you remember, 2006, 2007, they've tried to spark an equity bubble, which then makes consumers feel richer and then spend more, and that hasn't ended well. So I think what we are going to do is just muddle along, you know, make changes at the margin, maybe reduce the mortgage rate a little, but not something that truly is a game changer the way it was in 2016, 17.